welcome back. Today we're going to do part 2 of my 3-part series on the home buying and mortgage process and some of the various products and procedures that go along with it. Before we get rolling though, if this is your first time here at our channel, or if you haven't done so for us already, please like and subscribe below. Alright, so today's topic again is part 2. We're going to be talking refinancing and PMI, private mortgage insurance. Let's get right into the refinancing because it is crazy out there, everybody. I just read a stat last week. Mortgage rates hit another low. The 30-year went to 2.86%. Refinancing activity is through the roof. I actually also saw a stat that there are still millions and millions of mortgage holders and homeowners that have not done the refi yet. So I thought this is a really good time to be throwing out this 3-part series. Refinancing, what is it? So I think one of the biggest misconceptions is you are taking your current mortgage and you're just slapping on a lower rate. That's not what happens on a refinance. So what you are actually doing is you're getting a brand new 30-year mortgage for the original loan amount. So let's say you've been in the house for a couple of years and you want to refinance. You're going to start a brand new 30-year mortgage process. Why is this important? Well, as I alluded to on a previous video, which you can also link to below in the description, an amortization schedule shows this very well. Interest is a killer for the 30-year mortgage. If you've been in a house for a couple of years, it's not a big deal. Refinancing is definitely the way to go, and it usually is no matter what. But if you've been in a house for 7 or 8 years and you've paid into a 30-year mortgage and all that interest, and now you want to refinance, you are basically just throwing away all that interest that you paid into it. And this could be, upwards of $10,000+, even more. I mean, it depends on how much your mortgage is. But if you've been in the house for more than 5 years, I really encourage you to sit down and really get into these numbers because it can make a big difference. If you're not going to be in the house for a lot longer after you do the refi and you've already been in there for 5 or more years, probably doesn't make sense. Okay, so the process of refi is very similar to the underwriting process. You're going to want to get all of your tax documents in order, your W-2s, 1099s, your previous year tax returns. They're going to do the regular credit stuff, income verification, all those kinds of things. So in order to help the underwriters get through this as quickly as possible, you probably want to get all of those documentation pieces in order before you get started. The time frame right now is already pushing 45 days for refinancing because they're just so busy. I've talked to mortgage lenders, I've talked to other realtors. It is crazy. So make sure you've got all of your ducks in a row to make it go as quickly as possible. That's about it as far as the refinance. You can do a fixed to a fix. You can go from a fixed to an arm. You can do an arm to a fixed. It doesn't matter. It's very flexible. It's, again, kind of whatever you want to accomplish and whatever works best for you. You can also, like I mentioned earlier, click the link below to go into the detail on the fixed versus the ARM products. That's it for the refi. Pretty simple, but as always, extremely complex once you get into the details. So let's jump real quick to PMI, private mortgage insurance. This is a killer for a lot of people, and it's not something that you go into the process really understanding or knowing much about, and then all of a sudden, halfway through underwriting, they give you, your estimated cost, monthly cost, and PMI shows up for $200, $300, $500, and you're like, what is this? So PMI, private mortgage insurance, what it does is, this is for borrowers that put down less than 20% on their down payment for their mortgage. As is probably, obvious, lenders look at people that put a lower amount down as high risk, so they charge what's called PMI. It's an added cost to help the lender take on the risk of what's considered a lower than prime, or I don't want to call it a subprime, but a higher risk borrower. Let's just call it that. There are a couple of ways to avoid the PMI. I just worked with a couple, bought their first house. They worked with a lender on a first-time home buyer program. It was a 10-year ARM. They put down less than 20%, but they're not paying PMI. This goes back to my first video. Please do your homework and do your research and interview mortgage brokers, mortgage lenders, underwriters, credit unions. At least 3. I recommend 5 or 6. Talk to at least 5 or 6 people through this process to make sure you are getting all the answers and you're getting yourself the best product, the best rate, the best terms. Two ways to avoid the PMI. Obviously, you want to put the 20% down, but like I just mentioned, if you can't, there is a way with first-time home buyer programs and some ARM products. There's another way though. So you can take out a second mortgage. Let's say, for example, you take out a mortgage, you put your down payment down, let's say it's 10%. Well, you're 10% short to get to 20, right? So you got your first mortgage down payment, then you take out a second mortgage for the gap in the down payment. So if it's, you put down 10%, you need another 10, take out a second mortgage for that piece. Why is this helpful? Yes, you're gonna have a little bit of a higher interest rate on that second mortgage, but it's gonna be a lower loan amount, and you can do the comparison with the lenders. It's probably gonna still be less than PMI. Like I said, PMI can stretch upwards of 400 or 500 more per month. It's crazy. I mean, it's really, really bad. Honestly, there's nothing else to say. So, and that's why so many people are concerned about it and they want to know other ways to do it. So yeah, the second mortgage, you're going to get a higher interest rate than your primary first mortgage. But again, do the comparison, just crunch the numbers, and you'll see that most of the time that second mortgage has a lower payment. Okay, everybody, thanks again for checking out the video here on refis and PMIs. You can check out part 1 in the description below. Like I had already kind of mentioned a few times here in this video, I'm going to do part 3 shortly as well. We're going to talk about some different types of refinance, cash out refis. We're going to talk about HELOCs, home equity lines of credit, and also a home equity loan. All right, thank you guys for your time. Hope you found this valuable. If you have any comments or if you want to send us an email, please click the link below. Thanks again. We'll see you in part 3.